Hello and welcome to the first edition of AM News Update. I am Dariush Yazdani.
And I'm Zoha Ahmed.
In this show, we will provide you with coverage of recent developments in the global asset management industry, taking a look inside the latest trends and numbers.
We look at new products and recent reports and see who the most recent movers and shakers are. Combined with our expert opinions, this recap will ensure that you remain up to date. Dariush, let's start off with a look at our market analysis for the month.
Globally, mutual funds have continued to grow. The latest ICI numbers of Q3 2017 reported that total mutual funds AUM reached $47 trillion. PwC estimates that Q4 numbers will likely show a growth of around $2 trillion, having mutual funds end the year at $49 trillion, a growth of 22% year on year. With the recent market volatility, we expect the AUM of global mutual funds to remain at the same level during the first 2 months of 2018. Looking on a regional basis, the AUM of European mutual funds reached almost $19 trillion at the end of 2017. European mutual funds have actually grown at higher rate than the global average. We need to note, however, that the depreciation of US dollar against the euro in 2017 also contributed to the high growth rate of almost 27%. After the slight decrease in mutual funds AUM in Asia Pacific in 2016, the investment fund industry experienced consecutive growth throughout 2017. PwC estimates that the global AUM in that region has surpassed $6.5 trillion at the end of last year. Finally, turning to mutual funds domiciled in the Americas, PwC estimates the overall AUM to stand at approximately $25 trillion at the end of 2017. The majority of these, 88%, are domiciled in the United States, and the dominant market share of US funds remained stable in 2017. Let's have a look at news from around the globe.
Brexit has naturally been a large topic in recent months. We've seen many UK fund houses launch or shore up operations in continental Europe prior to any decisions being made. Recently, Aberdeen Standard indicated that they are planning to set up an EU hub in Ireland in order to continue serving its EU-based customers post-Brexit. Jupiter Fund Management, which saw net inflows of €6.25 billion in 2017, has also indicated that they are looking to make a similar move. However, they are targeting Luxembourg as the future location of their new portfolio management entity.
Interestingly, Zoa, we are also seeing firms from continental Europe ensuring their operations in the UK will run smoothly after Brexit. Nordea AM is in the process of creating a UK-based subsidiary in order to protect local business from any fallout.
Somewhat in line with this, fund passport regimes are also becoming more entrenched in the Asia-Pacific region. In fact, Singapore, Thailand, and Malaysia recently signed an MOU which revised the ASEAN Collective Investment Scheme Framework launched in 2014.
Yes, the new revision significantly updates the original framework, allowing easier access for small asset managers to offer cross-border funds. Originally, managers needed a minimum AUM of $500 million. However, this has been lowered to $350 million under the new rules. Furthermore, up to 100% of an approved fund's assets can be sub-managed by a manager who is not regulated by a signatory of the pact. Let's quickly turn to Justin Ong, PwC's APAC Asset Management Leader. Justin, thank you very much for joining us. How do you see this new MOU? Will it bring the much-awaited success of the ASEAN Passport? How does it compare to the ARFP? And which do you think will be more successful?
Thanks, Sarah, for asking. Now that's a great question. How do we see the MOU? We see it extremely positively. I think this is one of the big changes that's coming through, and it's a great enhancement to the existing regime under the ASEAN CIS framework. First and foremost, I think the ability now for managers to sub-delegate management of the AUM to countries and asset managers outside of host country is a big change. It provides asset managers with a lot more flexibility in terms of how they want to manage a product and how they build it, using the best capabilities around the world. And I think that's a great start, not just for the managers themselves, but for the investors who get access to the best products and best capabilities. I think the second thing that has come across, of course, is the expedited approval process and the clarity now given that funds once approved or once lodged will have 21 days approval. Provides managers with a lot more clarity, a lot more certainty in terms of how soon they can go and market their product. So again, I think that's a great change. So how do we see that stacked against the Asia Region's Funds Passport? Well, at the end of the day, it's a very long-term game. The ASEAN CIS has been around for the last couple of years. It's not seen a lot of traction, but we do expect to see some interest picking up now that the rules have been enhanced. The Asia Region Funds Passport clearly is a much longer game, much bigger players involved in terms of countries. We have Australia, Korea and Japan. So that's going to add a lot of weight to it. While the rules have been out, ultimately it's going to depend on the first two countries to sign on to a bilateral and start the funds on a cross-border basis, and then it basically goes live. So we think both have got a lot of legs. Ultimately, which will be more successful is going to depend on which managers feel more comfortable with from a distribution perspective. So, rules in terms of rules, fine, but how you distribute ultimately is going to win the game.
Thanks, Justin. I'm sure that as the passports grow in popularity, we'll see increased flows throughout the region. Now, let's have a look at what's been making headlines amongst actives.
In news out of the UK, the FCA has fined a number of unnamed asset managers to the tune of £34 million. This in regards to the regulator uncovering widespread evidence of closet tracking funds, charging investors high management fees. The asset managers will also be forced to change their marketing materials in order to more accurately reflect the nature of their funds.
Goldman Sachs and Amundi have joined forces to launch a Luxembourg domiciled liquid alternatives fund. This partnership will see that the French giant offer management, due diligence, and monitoring services to Goldman Sachs' UCITS platform. The collaboration will allow the U.S. firm to provide systematic strategies across Europe, as well as giving the firm access to leading hedge funds. With a strong growth in the market over the last year, let's take a look at what's happening with passives.
Passives have seen strong growth across the globe in the last year. The APAC region has seen the markets go from strength to strength, with ex-Japan ETFs and ETPs reaching a record high $184 billion in January, an increase of $14 billion. In Japan, the sum invested in listed ETFs and ETPs rose 7% in January to $295 billion.
In light of this growth, Dariush, we've seen more interest from players outside that market. US-based fund manager WisdomTree has, for example, begun to work with Hong Kong's premier partners to boost their ETFs in the region. WisdomTree's global AUM stands at approximately $46.8 billion.
Well, this partnership is likely to benefit both parties. Premier will be able to leverage WisdomTree's innovative tools and solutions for investors, and WisdomTree will be able to use Premier's already existing market base to broaden their footprint in the region. It's an excellent example of firms working together to achieve strong results rather than attempting to build capabilities entirely on their own.
Exactly, Dariush. In Europe, BlackRock recently decided to move $54.4 billion in German domiciled ETFs to Ireland. They decided to do so in order to provide their clients with the benefits of scale. This move was largely precipitated by the introduction of the German investment tax reform, which created a more equal situation between funds domiciled in Germany and those domiciled elsewhere. This move has bolstered Ireland's status as Europe's leading ETF domicile, with BlackRock's range in Ireland amounting to $349.9 billion.
In the US, January marked 24 months of consecutive inflows into US-listed ETFs and ETPs. According to ETFGI, inflows in January amounted to $219 billion, bringing total AUM to a record high $3.6 trillion. Equities were favored by investors increasing by 7.5%, which is significantly higher than the fixed income increase of 1%. Let's turn to PwC's Global Asset Management Strategy Leader, John Siciliano, for more information on the US markets. John, it's great to have you here. We have seen continuing strong inflows into the US passive market. How do you see this going forward, and do you think there is a passive bubble building?
Thank you so much, Darish. I think when you look at the US market overall, what we see is a continuing move to passive because there's been a fundamental shift from traditional defined benefit plans into defined contribution plans. And as a result of that shift, the choices that many individual investors make is to move to passive because they understand it. In other words, it's transparent, and the fees are highly competitive, which means that they are lower than traditional active products.
Thanks, John. With the strong bull run we've seen, it's understandable that investors are drawn to the returns that ETFs can provide. Now, let's turn to alternatives and see what's happening in that space.
The worldwide private equity market is growing at a staggering pace. In 2017, a record 425 new PE firms entered the market, and dry powder reached never-before-seen levels, amounting to $1 trillion by end of 2017.
Both these trends are contributing to the increasing levels of competition seen in the PE industry, causing bidding wars and raising the valuation of potential targets.
PE is not the only alternative to see strong growth. We expect a soaring growth in infrastructure. Mass urbanization in emerging countries is leading to an increased need for water, power, and transport facilities, with AUM set to increase at a compound annual growth rate of 21.3% between 2016 and 2025. Assets are set to more than quintuple over this period.
The APAC region is expected to capture a large amount of this growth in the coming years, and the New Silk Road and Belt and Road Initiative take center stage.
Let's turn to research reports which seem to closely reflect our news from this month.
PwC released a report entitled The Rising Attractiveness of Alternative Assets for Sovereign Wealth Funds. In this report, we detailed how SWFs now allocate 23% of their AUM to alternative investments. We did, however, note that investing in alternatives is not without risk, with the majority of these asset classes being highly illiquid.
Sticking with institutional investors, another recent report by UBS, titled Building Passive Solutions, highlights how sovereign wealth funds and central banks have embraced passive strategies. This is mainly because of the liquidity, transparency, and low costs. But the goals and restrictions of both institutions vary vastly and call for customized options. The report also highlights that asset managers need to meet the evolving needs of these investors in the passive space. You have been watching AM News Updates. That's all for today. Thank you for joining us.
Please remember to like and subscribe to remain in the know. Thanks for watching. Goodbye.
Goodbye.